shall we bring today's episode home with a devastating estate tax that could wipe out 40% of your entire investment portfolio?
Do you want to do that, or do you want to save that for next time?
Because it's top of mind for me right now. And I would feel bad if one of our Patreons died before next week and they were subject to this.
Hey, John, don't get eaten by any pythons or anacondas that are lurking in the jungle, please. But if you do, then that has some really bad news for you.
Now,
other than that you're dead.
I'm being a bit alarmist, but this is very real. And I and my buddy Albert and a couple of my friends who study this stuff and know investing had no freaking idea about it. I was going to get potentially caught with my pants down. And credit to the Dividend Talk community, because our friends Edgy and Derek, amazing dividend growth investing podcast, and they got a really good community, and I'm in that community, and I lurk a lot, I read a lot, I rarely post. But this came up on their podcast 2 weeks ago, and I think it's really important, so I want to share it here, because I'm sure this impacts at least one of our listeners out of our thousands of subscribers. Right. If I had no idea about this, if you guys, you Americans, holy F, right? How did you sneak this in for the way you tax? Because it's completely...
Wait, so I'm the one that should be scared, or you?
You're good. You guys are screwing us. You guys are screwing...
good. Okay. Good.
This is so counterintuitive, right? I thought I was deluded into thinking, oh, I'm good. I've got a will. I remade my wills recently, and I got to pay, UK inheritance tax, and I'll make some provisions and structure around that, and I'm all set up. I have now learned about this US estate tax. So, if you are a non-American investor in many, many countries of the world, if you own US assets, which includes any US incorporated companies. So, like Teslas and Alphabets and Metas, like most American companies are incorporated in America. There's a few exceptions. When you die, your broker will freeze your assets, and they will require your estate to complete a fairly painful process involving submitting a 706-NA form, the IRS. And I'm not joking, your estate will have to pay 40% of all of your US assets to the IRS before your broker will release your funds to your estate so that your executors can deal with it. And there is if you're an American, like this tax applies to you as an American, but you have something like a $13 million exemption, estate tax, like buffer. So the first $13 million that you leave to your inheritors is tax-free. If you are a non-American leaving American assets, so like your Google stock, if you're leaving those to another non-American, like your wife, who is not an American, 40% tax on all your American stocks above $60,000.
So the difference is Americans get 13 million exemption, and you poor Brits and other foreigners get 60,000, which is relatively nothing. Like, right, 13, right. So, that's not good.
It's not quite right, because there are certain treaty companies. But if you're like in Spain, Ireland, Hong Kong, Singapore, Dubai, Portugal, that's it. That is the deal. Everything above $60,000 is taxed at 40%, and you can't get out of this, right? There are ways to structure, which I'm going to tell you about now. So if you're suddenly sitting forward going, what, like Google US estate tax, this is absolutely legitimate. I've been down the rabbit hole with this in the last few days. Now, if you are a UK citizen or Germany or France, there's a number of other countries, then there is a tax treaty between your country, between, say, the UK and the US. And as of the 1st of January, that means as a UK citizen, instead of being 13 million, my limit will be $7 million. So you might go, okay, like, boo-hoo, right? But if you've invested for a long time, you might be sleeping on, by the time you get to your 60s or 70s, you might be sleeping on a portfolio that's worth more than $7 million. And in fact, not even a portfolio, your net worth, if your net worth is worth more than $7 million, which is about £5.5 million today, then this tax kicks in and you would potentially liable for 40% of all of your US investments as a proportion of the $7 million. So
if I could summarize right now, Badge, bad news. One, you're dead. That's the first thing, right? And two, because you just got yourself eaten by some poisonous snake, your estate, the people who handle your business, unless you're part of a couple of these exempt treaty zones, you're going to lose approximately 40% in all of the U.S. incorporated companies. Is that correct for now? That's the summary for now. So is there any good news in any of this?
Now that you are aware of this, go and look into it. If you're in like a country like the UK, okay, sure, $7 million is a big number. Like, not many people have that kind of wealth, but maybe plan ahead. And if it makes sense, like, I am not a lawyer, I am not a tax advisory, I'm just telling you about this thing. Now go and do your own research. There are ways to mitigate this. And if you're in Ireland, like, this is particularly important because you only get that $60,000 limit, not the $7 million limit. There's two ways to legally avoid this tax. One is, instead of owning individual stocks like Google and Meta and you buy a non-US domiciled ETF that tracks the US stock market. So you would buy, for example, we talk about VOO, VOO, it's like the S&P. So VOO itself is a US incorporated ETF. So you can't buy that one, but there are Irish and other markets have their own version of VOO, which track the S&P, and they're incorporated in the local country. So those would be outside the scope of this. So, but that's kind of boring, right? You don't want to own ETFs. You want to own individual companies. And that's like, this is like my mission is to beat the market, pick stocks. And so that's no good to me buying an ETF, but that would be good for the majority of people who aren't like dyed in the wool stock pickers. If you must own US assets, and if your intention is to leave like the majority of your estate to your spouse, then you can have it's recommended you create a US will, so a second will for the US, which have to meet certain criteria. Like, you'll have to employ like a lawyer or an estate person to help you set this up. And your US will create a qualified domestic trust, QDOT. And that would allow your estate, at least your spouse, to defer the taxes, but the taxes are still due. So it just means
All right, Badge. Sorry. I mean, this tax talk is making my eyes roll in the back of my head. I'm sure half of our listeners already also might have died, but this is important. No, sorry, not died, because that would trigger all this. So they fell asleep or they fell off their chair. Let's get to the real most important point here. Let's get to the, as they say, the monkey business. All the bananas that you're going to leave your humble co-host after you kick the bucket, falling off some cliff, skiing, or jumping off, or wherever you're going to be jumping off a motorcycle. What do I got to do? What do I got to do to secure all the future bananas?
You're a citizen. I could leave stuff to you, no problem. I just can't leave it. Yeah.
Oh, you can.
Leave it to you. I can't leave it.
You know, it's not like I'll reinvest it all in What's the in Beyond Meat? I wouldn't do that. Would I? Would I disrespect your legacy in that way? No, I would put it all into Greg's sausages.
Yeah. Well, like, I am laughing because it's like the things like Greg's sausages in my portfolio are sort of the only positions that are immune from this. Almost everything else is US incorporated. But you're right, let's bring it home because most people this won't affect. But this is real. If you're not a US citizen and you own US stocks, you are exposed to this tax. If you're not in a treaty country, you're almost certainly exposed to this tax today, as opposed to in the far future. You should get legal advice on this if you think this impacts you. And the key thing is the place of incorporation of the companies you own. So it's quite interesting because I looked down my whole portfolio and did a quick bit of Google to see kind of where they're incorporated. So like some were a little bit surprising. Nubank is like South American, that incorporated in the Cayman Islands. So that's good. And I expected that. But Mercado Libre is also like south of the border, but they're incorporated in Delaware. So that's bad. That falls into the scope of this. IREN, one of your favorites, well, that's an Australian company. Great. Even though it's listed on like the NASDAQ, it's incorporated in Australia. So that's kind of okay.
Actually, they're moving to the US, but
what Wise, right? They're a British company that are about to like re-headquarter and relist in the US. That's going to be bad for this because it will fall in scope. Shopify, company I used to own, Canadian, like immune. So that's the kind of analysis you need to do in your portfolio to figure out the extent to which you might breach this. Can I just give like one more minute to this topic? Because in the dividend talk community, they were debating like things that you could do. And it's almost like, half jokingly, I just want to kind of address these head on, right? You might think, oh, I'm just going to leave everything to my spouse. It's tax free. We've now established that's not the case. You can't expect your spouse to go into your brokerage and just quickly, they've heard you're dead. And the first thing they're going to do is go online and find your 2FA codes and log in and sell all your US stocks. Even if they were able to do, overcome their misery or celebrating, God knows, and successfully do that, that don't count. The IRS will look through that transaction and it will just make things worse and more complicated for the people who inherit from you. So if it impacts you, do it properly, get proper estate planning advice, and then don't get caught out as I may have done if I hadn't have caught that 2 weeks ago.
Just make sure Monkey gets his bananas when you kick the bucket. That's the TLDR. Okay. You sign the things. Okay. Badge, thank you for bringing that to our attention.